Today on the Accounting for You podcast, we're talking with John Snodgrass. He's with Benefit Design Services, and John is a specialist when it comes to health insurance plans for small businesses, individual health insurance plans, and even Medicare plans. Welcome to the Accounting for You podcast, brought to you by the accounting firm of Adkins & Reynolds CPAs. This podcast is designed to provide relevant tax and accounting information to help you and your business succeed. If you enjoy listening in, please like and subscribe to our channel. Now, on to the show. Well, welcome back to the Accounting for You podcast. I am Chris Reynolds, CPA and partner with Adkins & Reynolds CPAs.
And I am Jay Adkins, CPA and partner at Adkins & Reynolds CPAs.
Well, as I mentioned there in the opener, we have a very special guest today, John Snodgrass with Benefit Design Services. And we're going to be talking today about health insurance and other benefits that small businesses can offer to their employees. And we'll even get into some individual coverage questions, especially when it's talking about the Affordable Care Act, Obamacare, however you may want to say it. And we'll see where the conversation leads us. But we want to introduce John Snodgrass.
Hello.
John, tell us a little bit about yourself.
Well, Benefit Design started in 1989, so we're in our 34th year. Bob Crabtree and I are partners, and we had Stephen Jones. Some of y'all may know him, and he retired a few years ago.
Okay.
Living in South Carolina with the kids and the grandkids.
All right. So what does Benefit Design Services do? What's your main job there?
Our main job is group benefits. We do all types of employee benefits. We specialize in group health, but we also do disability and life and dental and vision and those kind of things, as well as individual plans and Medicare plans.
Okay. What's your favorite part of this?
Well, really just helping people understand the maze that they got to go through when these things pop up, whether it's group or what have you.
Right.
Everything has a million facets to kind of figure out.
Mm-hmm. And full disclosure, John did help me with my own health insurance issues in the last couple of years, and it was quite the maze, and he successfully brought me through it.
There you go.
So without John, I don't think I could have got it done. So. All right, so John, when it comes to talking about health insurance and small business owners, we know the Affordable Care Act, Obamacare changed the world when it comes to that and what small businesses are really looking for. But let's still talk. I mean, there still is group health coverage. Obviously, larger employees offer it, and small employers can offer it. So, lay out the different types of health insurance benefits that a company could offer.
Well, there's the main one that most people have in a small business are fully insured. Mm-hmm. They're age rated, guarantee issue, no questions asked, literally no waiting periods for pre-existings. You pay your premium, they pay the claims. That's how it works, you know. And then there's, of course, various deductibles and things to make a plan better or less benefit, so to speak, to take the premiums down.
Okay. So what, and this is just the traditional type of health insurance.
Right.
But it's quite expensive these days.
It is, especially, if you have a lot of employees have been with you a long time. They're very efficient at their job. They're helping you. They're making you money. But this is an age-rated product, so the older they are, the more it costs.
Right.
So it kind of offsets some of that a lot of people say, oh, man, if you have a bunch of younger people, you can save a boatload on your health insurance, but you're always training them and teaching them things that the older employee already knew,
Right.
So it could go either way.
So, John, in talking about the health plans that you're talking about, the traditional ones, the high cost is a tremendous problem for a lot of small businesses.
Yes, sir.
So what direction could a small business go maybe in a different way to help with that cost?
Well, if their people are pretty healthy, there are new plans out that are called level funded, and it's kind of a hybrid between fully insured and self-insured, and that scares small business to death, and it should, because fully self-insured is pretty risky. But these plans basically break out all the factors of what's in a plan and say, we have this much of a claims corridor. If you have more than this but less than that of claims in a particular year, then they give a little time for that, all the claims to go run out, we call it. But then there's a refund back to the employer. So they're paying a certain premium that's usually already less than what fully insured costs. So there's your savings. But then you could get an additional bonus, you might say, in a refund if that happens to work. And if it didn't, you still save premium dollars up front. Now, on a larger company, that's a little bit of risk, over 50 employees, because the companies, if you say, I don't really like this, I want to go back to what I had, you may not be able to get back in there as good as you did before. So, but with small business, that rate's already there. It's guaranteed up to 50 employees, age rated. You're right back to that same situation. But sometimes, you walk in and you have a healthy half a dozen or 12 or 15 people, and then somebody gets a leukemia or somebody has a preemie baby or all these things that just pop up and cost a lot of money. Now that's still ongoing when it comes time for the renewal. So they bump the rate up on you. But if it's more, you're just kind of in the driver's seat, because if that employer says, okay, well, they raised it 25%, which is crazy, but it's still cheaper than the ACA plans that we're looking at. So it's a good option.
So from the employer standpoint, can you explain a little bit in the hybrid how that works as far as the claims? If it's somewhat insured by the insurer, but there's risk for the employer, how does that really work?
Well, the insurer does pay. They still have, if you have the plans, PPO plans, you have that same network. Like you're used to going to that doctor. There's no concern about that as far as an employee. And the employer, just again, they paid all that extra premium. They've added that claims corridor in that premium. So officially, there might be some kind of talk about a certain amount of what we call stop loss per given person, but it's really a moot point in a small business situation. They're paying that premium, but the carrier is also just paying the claims as is, and really it just comes into play at the end of that year. The money that potentially would be there, then there could be a potential refund back to the employer, and the insurance company gets a little bit of it.
Okay.
So it works both ways.
Okay.
Yeah.
Okay. So what, based upon the traditional type of health insurance plan and this hybrid plan you're talking, what kind of price difference are we talking in general for a small plan?
Well, that's where it gets iffy, because if you've got a bunch of healthy people, like I've got a renewal that just now came up on a fully insured plan, and that carrier offers this level funded. So they pre-qualified, you might say, this group that's coming up, and they said, we'll give you that same exact plan design and save you 25%. That's significant money, right? And it's like getting 2 months premium free or 3, so that's a great thing. So they've already pre-qualified them in this case, and they can just sign up for it. But if it's somebody that says, hey, I want to try this, and so shop that out for me, John. Okay, I will. You've got to fill out this health history form on all your people. Well, technically, the people have to fill it out for themselves and their dependents. And what have you had? And if you had this in the last 5 years or the last 10 years, check this box and tell us about what medications you might be taking. Full medical underwriting, like the pre-ACA days. But that helps that company know what risk they're taking and assign a dollar amount to that to cover that risk. So if that's the case and there are a few things present, they can say, well, it's going to be this. So it's not automatically a 25 or 50% savings. And sometimes it is. It's just each group has its own set of risks, so to speak, to it because of something that's going on as those forms are being completed.
So, John, you were talking a little bit, too. You alluded to some self-funded or self-insured options for small businesses. What does that look like?
Well, and that's very few people do it in what we call a real self-insured. If you have less than 50 employees, it's pretty risky, because at that point you are taking on, you have two types of risk for an employer. A per person, we call that a specific stop loss of $25,000, say. And then there's an aggregate on the end. So you have two different insurances that you're paying for. And so the employer pays the first, say, $25,000. The employee is still paying their deductible and coinsurance within that, but the employer is on the risk for it. But then if he has this many, that many, this many, that many of various things that pop up, there is an aggregate maximum that he has to be concerned about.
Okay.
If he gets to that point, then all the claims are paid. But you get into some logistics there of legalities of the contract, because now the employer with those type of plans is the insurance company. And what we would consider the insurance company, all they're doing is processing claims, fiduciary responsibilities and some things like that. So sometimes the employer, without recognizing it, if he doesn't have the correct guidance, can be in a kind of a pickle, because he's just assuming that this contract they showed him is all compliant with the ACA, et cetera. And then a claim comes up that the specific or stop loss carrier says, we're not covering that. It's not in the contract. Oh, really?
Yeah. Okay.
What does that mean to me, Mr. Insurance Agent? It means you've got a claim. You're going to be paying it,
So you're saying with this type of plan, there's still co-insurance and stuff on the employee
Yeah,
that
the
they're
employees
still
don't
going to be
really see a
responsible
difference.
for. But, the old plans were 80-20,
Yeah.
So the employer's covering the other part of that?
Yeah, they're covering
themselves?
the 80,
Okay, so
basically,
that sounds like that could be really expensive,
Yes.
really fast, especially if someone had a major health crisis.
But again, it's on that one person that has heaven forbid, a brain tumor, or I mentioned a premature baby. You're looking at $250,000, but that $25,000, that's it.
Okay. So,
And then it rolls up on that person. That's the most that employer is going to be on the hook for.
okay.
There's a risk of having multiple people that have
Boom.
problems
Yes,
that
sir.
would be 25 each potentially.
Yes, sir. And that's why they throw that aggregate in, which is the aggregate is considerably less than the total of those individual ones. Yeah.
So who is what kind of employer or what kind of business is best suited for something like that?
The closer that an employer would be, even in we consider small business, 50 employees and less. Okay, so upward toward the top of that, toward 50 employees would be the minimum I would even be comfortable, really pursuing that.
Okay.
If I was talking to an employer in that situation, I would get my toes in the water with level funding, so to speak, if I was so inclined to want that, to get away from that age rating process.
And with that number of employees, you think the business is pretty, hopefully solvent, and they have plenty of cash that can pay for.
If
things
you're going
that
to go
pop up.
self-funded, you need to you need to have some cash flow.
Okay.
Because there's going to be some months you're going to have to write several $100,000. If you've got 40 employees plus spouses plus some kids thrown in, that's 150 people. So in that respect, you've got some. You better have a check ready.
So key idea takeaway there is stay away from that unless you're big and rich.
Or at least, like you said, solvent is the minimum requirement. But
Gotcha.
but you do have to have some cash flow.
Not to be taken lightly.
Yes.
Probably not for your mom and pop business
Absolutely
that has a
not.
handful
No.
of employees.
Yes.
No. So most small business owners, when they've decided to offer health insurance to their employees, and let's say it's we're a new business, we're going to offer our health insurance. We don't want individuals to have to cover themselves. We're going to offer a group plan, and I'm the employer coming in to pick the plan, or at least to start that process. How are you going to advise me, or what key factors are we going to be looking at as to what kind of plan I need and what product per se with an insurance company?
Well, one of the best things. I mean, you've got to sometimes search for something you consider a good thing with the Affordable Care Act, but as it affects employers, they do get even clear down to 2 employees. You can write a group of 1 if there are 2 active employees.
Okay.
I mean, if that one employee is covered by their spouse and you're the only one as the business owner that needs it, we can write you a group. It's an odd thing. But the point is you can have a dual choice. Like some people want to have a high deductible plan that has a health savings account attached to it. Okay. But then somebody else might have, I'm taking this $500 drug, so I need a drug card. So I need a different plan with a, that type of more traditional thing. So we can do that. And then they just pick and choose. And the employer can say, I'm going to pay certain percentage of this level of benefit, and you can buy up to that, or I'll pay 50% of whatever you do. I mean, it's as long as you don't cross those lines once you draw them, then the employer's pretty open to be able to do what they want as far as that kind of thing goes.
And obviously, you can't have various products under one group. It's either a traditional health insurance plan or it's a high deductible with a health savings account type.
Well,
plan,
like I say, you can have two.
Okay.
You can have a HSA, we call those health savings account plans, and then you can also offer a better plan if you want, and that allows people to have a little more say in it,
choice,
and how much do they want to spend, out of their check each week. So.
Now, when we were talking about health insurance, you had some gems of wisdom of looking at plans, because it's kind of like buying a car. This car is very similar to this car, but when how long's the warranty, how long, different things like that. So when it came to the health insurance picking, I think we were talking about maybe our total cost out of pocket. Can you speak to that on when picking a plan?
Yeah, the employer, you have to see how much, this particular plan is going to be $12,000 a month with these various people and or their wives and kids and husbands. So you have to determine, I'm going to pay all of the employee, or I'm going to pay half of the employee and none of the dependent, or half and half across the board, whatever it is. Or there's just certain things like that you have to see what can you afford to offer to your people. Then once you determine that, then we go in and meet with the employees and say, hey, your employer is going to do this for you, and it would cost you this much per pay to add your spouse, add your kids, what have you.
Okay.
And that's an important part of it. That's why we talk to the employers first and give them the numbers so that they can crunch it down with people like you to say, what can I afford to do, right? And once you all come up with that information, then we can present that to the employees to where they can understand the benefits and the cost and, again, what it's going to take out of their checks.
So you were talking about the employee paying some of the cost. Obviously, an employer could pay 100% of health insurance for someone. Is there a minimum that the employer has to pay if they cover or have a group plan?
Yeah, the insurance companies. I'm trying to, in my mind, I don't know if it's an ACA rule or just the insurance companies, but most of the insurance companies say that the employer has to pay at least 50% of the employee cost.
Okay.
They don't have to pay anything toward the dependents as far as the insurance companies are requiring. But if you want a plan, there are also rules, we call them participation guidelines, that you have to have a certain percentage of people. And if you're only paying 50%, chances are you're asking that employee to pay that $100 a week or whatever it be. And that's a great deal if he's so inclined to want it. But, hey, he was spending that $100 on something else last week.
Yeah. Right.
And it doesn't matter, and I say this to employers all the time, it doesn't matter if that was baby formula and rent or beer and cigarettes, right?
Right.
All they know is you're going to take $100 out of my check on Friday. I just got paid last Friday. It's Tuesday, and I got $12. I can't afford it. That's just their automatic answer. They have to also be engaged in it and want it. And we'll probably talk about this later, but that's one of the challenges for a small group to get started because of the Affordable Care Act and how the marketplace gives subsidies to help people with this kind of thing, especially the lower the income, the more they help. So there's a disincentive for an employee to want to be eligible for that, or so the employer could actually hurt them while they're trying to help them.
Right.
So that's a challenge to jump into there.
Yeah. But a key takeaway in this I'm getting is that when you get a health coverage small group plan in place, the employer is going to have to pay some of that premium or a larger percentage of that premium. Yes. So there is a hit in hit and cash flow there for the small business
Yes,
owner,
sir.
because you can't just say, hey, we've got a health coverage plan and good luck to you.
Well, we've seen that with retirement plans. I don't do retirement plans, but I've seen that employers, okay, I'm going to offer a 401k. Oh, I'm not matching it. You know, and it just automatically deflates that balloon. The employee's going like, if you're not matching it, you're not helping me in it. I mean, I know I probably need it, but I can't afford it. If you can't afford it, I certainly can't afford it.
Yeah.
That's the attitude that comes across.
But then there's also on the flip side of that too, with the employer that you're talking, once you do offer these plans and they want to get on there, then they may be out of pocket that they're not maybe thinking or planning on, that they're going to all of a sudden have to potentially start taking money out of their paycheck if the employer's not covering 100% of the premium for them. And I know you were talking a little bit about the Affordable Care Act and how that can be a detriment to a group plan. So if I'm an employer and I decide to offer a group plan and I have employees that are already insured through the marketplace, through the Affordable Care Act stuff, what happens to them?
Okay, let's say here we are in the middle of the year and that employee or employees are already on the marketplace. That would not affect them. They could opt out of the group plan at this time, and I'm making that specific, at this time. But when it comes time for open enrollment in the fall each year, the employee has to answer a question on the application differently, and that question is are you offered a group plan? Yeah. Okay. Then the question says, okay, yes. Is it compliant with the Affordable Care Act? It could be a $9,100 deductible plan, but that's still compliant. That's minimal, but it's still compliant. So they say, yeah, it's a terrible plan, but yeah, I'm offered it. Is it affordable? And the federal government considers affordable if the employee has to pay more than 9.12% of their income, not the household income, but of their income, then that's affordable. If they have to pay more than that, it's not affordable. If they pay less than that, it is affordable. Okay? So that means that if they have a compliant and affordable plan, that employee cannot get a subsidy for the next year. Okay? So come January 1, they have to either way, they're losing their subsidy, which means in all effects they're dropping their ACA marketplace plan, and they can either get on the employer's plan, which is a lesser plan at more money, or just go uninsured, which 25 million Americans have opted to do, you know. So it's kind of a weird situation. The good news for an employer on that is they've heard about, you know, these employer mandates. That, again, only applies when there's over 50 full-time equivalents. And equivalents meaning 30 hours a week, and then you add up the part-timers to see how many 30s that would make, and a big formula like that. But the bottom line on that is the employer with less than 50 full-time equivalents will not be assessed a penalty. If an employee fudges, misunderstands, whatever, and goes ahead and gets a subsidy, and then eventually the IRS figures out, hey, wait a minute, this bank downtown has this, you know, group plan, but Susie or Johnny aren't on it. So they figure out, hey, we gave them a subsidy. They didn't offer them a plan, and they get a bill for about $180,000.
Oh, wow.
Because they don't do it on just one. They do it, they say, okay, the penalty is $3,000 for basically putting somebody in the marketplace with a subsidy when you should have had them on the plan. But they're going like, okay, $3,000, and you got 50 employees, $150,000.
Yeah.
And I've had a few of those that, again, just the employee said, I told them that, but they just went ahead and wrote me up, you know, whether it was a navigator or somebody in the marketplace, whoever they were speaking with. And we explained it to the IRS on my client's behalf, and they said, oh, okay, send us a letter, and it's all good. Whew, that was close, right? Yeah. They immediately thought I was the guru at that point.
So potentially an employer trying to give a benefit to employees if the plan wasn't good enough could force the employee out of the marketplace and onto a plan that's detrimental to what they had on the marketplace.
Yeah, it's true, because
it is complicated.
It very much is, and especially if you have lower paid employees. Let's say it varies because the number of people in the family determines some of this factor. But bottom line, if you pay somebody, or if their household income, let's say, is in the $25,000 or $30,000 range, they could have a plan that an employer could, I'll just basically say, never afford, because not only do people get a big discount on the premiums when their income is lower, they also enhance the benefits to where they come in as a silver level, but it becomes a gold or even a platinum level benefit. I got to work on these things here. Okay, that's better. I'm falling off my head there.
So if I'm a small business owner and I have a health insurance plan, small group plan, we've navigated all the potential subsidy problems with anybody, and we've decided this is what's best for our company, and we have our premium set. Is there any kind of programs, additional programs I can offer to my employees, like wellness programs or anything that might benefit and reduce the premium at a future date?
Well, the only way a wellness program, let's start with that, for small business. I'm back to small business.
Okay.
Small groups are not credible. By that I mean if you have 50 people or 40 people, let's go back to that, and you're a small business, you've got 40 people on the plan, nothing you can do, good or bad, is going to change that premium.
Okay.
It's just what's the zip code of that employer, and what's the age of that employee and that spouse and that child. That's what's going to determine the rate for each given plan. And whether they're sick or healthy doesn't matter. Mm-hmm. At this point, especially in the tri-state in West Virginia, Ohio, Kentucky, they technically have a tobacco user column, and on individual plans, they bump that up quite a bit. But for group plans, it's still the same price either way. So even that, then that's the only medical question there is on those forms.
Okay.
Yeah. Now, if you get into the level funded, then again it's more claims driven. So yeah, that could help you down the road get some of that, some of that help.
All right. So if we've got plans set up, we've got health insurance, what kind of other benefit plans might I offer an employee?
Well, especially in lieu of, but also on top of the health insurance, if you find your people are all pretty much ACA and they're already in and everything's good there, it's not a benefit to them if you're not going to really help them, right? So on the other side of that, though, things that aren't covered by the ACA, dental plans, vision plans, especially life and disability. Disability is really important, and it's, what's my word, mainly undersold. It's never underbought. It's always undersold because we don't talk to our clients about them enough.
Right.
But disability benefits saves employers a boatload of money on workers' comp a lot of times, especially if you have people that are younger or more blue collar that do a lot more activity outside work. But if they pull their back and there's no insurance, they're gonna, but then they have a physical job there. Who's to say where that back injury happened?
Right.
And then of course there's always those things. I broke my leg or whatever, things that just happen. And you want to help your employee because we're small, so we're a big family, so you keep paying them. And you guys can talk about the tax implications of that. But to my point is, where do you stop? If that's, okay, you'll be off 4 weeks, and then it turns into 6 weeks, and then it turns into 8 weeks, and now you've got to cut the guy off, and now you're the bad guy.
Right.
Is he milking it or is he really sick? If you had disability coverage for your employees, the insurance company takes that monkey off your back, and they know,
right,
and they're asking the doctors the right questions and so forth to see, is Johnny or Susie, should they be back by now?
Is it now? I can offer like just say dental and vision to my employees without having to offer health insurance.
Absolutely,
right? That's a separate complete plan.
All of those things, and there's some people really go into cancer plans and critical illness, like it only covers like heart attacks and strokes and certain things like that, aneurysms. There's great benefits out there. It's just, what do you want to offer your people that will be perceived as a benefit? I mean, that's the whole idea of doing it, is to take care of them. But if they're going like, I'm not interested, then they don't see it as a benefit, and they're not impressed by you offering it.
Right.
There you go.
Is there any in those type of plans? Are there any responsibilities of the employer to pay a percentage of the plan, or
That's not required. They have both employer plan, employer paid plans, and then, of course, employer contributory plans. In other words, the employer pays a percentage of it, or purely voluntary, and all you're doing is offering the payroll deduction. You guys could address the Section 125 parts of that, where the benefits premiums come out pre-tax, and of course that saves the employer on Social Security, comp, and unemployment costs, but it also saves the employee about 25% of their cost of that on their take-home pay. So it's a win for them. I always tell folks that they should not do that for life or disability,
right?
because if you get the tax break on the premium,
Right.
then the benefit that the employee would receive that they really need is taxable.
Yeah, we had just had an instance with a client where we uncovered that they were actually running their disability plan through a cafeteria plan and taking it pre-tax, and we've got that stopped, fortunately.
Yeah,
but
good.
Fortunately, no claims have been made on it. We could fix that, but yeah, that's obviously a big problem when it comes to,
and you
especially
assume,
disability.
It's
yeah.
voluntary, so we do it all pre-tax. Just
Right.
to save them money. You got good intentions,
Right.
But that's why you've got these guys.
Yeah, very good.
Help you with that.
So, do you have any like big success stories where you've come in with a new customer and really saved them or helped them with a a small group plan or anything?
We've done that on several occasions, and a lot of times I mentioned earlier about up until let me kind of preface it. Up until 2021, if you made a certain amount of money based on your family size, you got zero help from the government. I mean, it's math. You make this much, fine. If you make that much, you're on your own, and you get zero help. So we were able to help several people over the years. With one in particular owned a small restaurant, a little pizza shop, and stage 4 cancer this person had with no insurance. So we were able to write them a group plan, and they were the only ones that needed it. And the other people were already part-time and or covered by their spouse or whatever. So we were able to write the group for this person and literally saved her from bankruptcy. I mean, that's a good feeling when you've got a way to work out those details, and when it can work, you can make it work. Everything's above board, of course, but also it's very fulfilling to know that they're still around, health-wise, but also they can still be around and not have anything to show for it other than their health, because they lost everything to pay for that treatment.
Yeah.
So we've got several of those type of situations, and then of course just other ones over the years. I mean, I started with Blue Cross in '85 and MetLife before that. But when I was with Blue Cross here in Huntington, I had a guy owned a business in town, and he had 3 children that had a very rare disease. And I was talking with him about claims and all that, and he was so appreciative. Back then, you didn't have a drug card. You just turned your drugs in like under a separate plan. And he refused to do that. And I would say, come on, man, that's good. Nope, I'm just so appreciative that they kept me, alive and kept my kids alive, that I don't want to bear that. He just bear that burden himself with whatever medications he did. And that, but it's still a budget buster, so that's just the people that appreciate what's been done for them.
Well, John, I don't think we really have anything else. We really appreciate you coming in on the show, and we'll maybe have to have you in again sometime to delve into even more health insurance stuff.
Be glad to.
Okay, great. And like I say, all of John's contact information will be down in the show notes, and our contact information is also on there. Feel free to reach out to us. And other than that, we will see you on the next Accounting for You podcast. Thank you for taking time today to listen to our podcast. We appreciate listeners like you and ask that if you enjoy what you hear, please like and subscribe to our channel to ensure you receive the latest episodes as soon as they come out. If you have any questions about the topic we discussed today or would like more information on becoming a client, please do not hesitate to contact our office by visiting arcpas.com or theaccountingpodcast.com.